We're going to go through the software and look at each of the fields and tabs so that you can be very comfortable in entering it with your casework and your tests that you're going to be doing and then your final exam. So if we look at where we start, if you're clicking on New, these are all the tabs and fields that you're going to see. If you want to do the overall one, you can have under the Agreement tab, which shows you Common, Agreement, and Opening Net Worth. We would start with Common, and we'll come back to these after. These are the number of years you're going to project out. So it defaults at 15, but if you've got a young couple, maybe they only want to look at 10 because it's a short-term marriage, or maybe even 5. If somebody's looking to go into retirement and want to see how things are going to turn out afterwards, then they may want to go 20, 25 years. The current year, again, will default to whatever year it is that you're in at this point. If you had work that you had done last year, for those students or members that were working on things in 2014, for example, they can go back and choose 2014 so that that's where their start year is. And these are really for the future, but at this point in time, you would not use 2016 or 17 because your start year is going to be now, and it wouldn't work if you use these years that haven't even come into being. There's a field here to put in the child's name and their age at this particular time. This would be this whole section is to do with going to school, so you would put in the age that they intended to do post-secondary starting, and then when you think they're going to finish, and whatever amount is going to be transferred to the particular parent, up to $5,000. So it would be claimed by either the recipient or the supporter, and you'd make that choice. If there was an equalization payment, you could use the field down here, and you would choose who's paying whom. And so here the one you're going to pick is who gets the money. So if it's paid to the recipient, then you would choose them. You could pick, which oftentimes it's a lump sum, so let's say it's $50,000 paid in year 1 or year 2, and that would show up. If, on the other hand, this annual amount is going to be paid over a period of time, maybe you put in $10,000 and it's being paid over 5 years. So $10,000 would be received every year for the next 5 years. We'll then say that a good idea is to save whatever, so that you know that you've named your case. Go and do a save as. You're going to look in your area and pick where you'd like to save it. In our case, this is where we're saving it, and you would name your case. And just click on save, and now after that you can just hit save period, and you're going to be able to just save to the same name case that you are working on. So then, as I said, we go to supporter, type in the name of your supporting person, type in their age, and you would put in state, city, province, etc. This is really for your records and benefit, or for the client. The key one for the calculations is the province for taxes. So you would choose through the drop down what province are they living in, pick that one, and then you're good for all your calculations. We'll come back to this, the person with complicated investments. We'll look at that when we look at the investments tab, so it's a bit easier to understand when you use it. And then in the notes section, you can put whatever you want. So in this particular case, we're saying that his spouse, they've been married 20 years, and his spouse is going back to school. He's agreed to pay for her education. So here, the personal deductions that are already calculated that you don't have to worry about are the basic personal deduction, the age amount, the pension income amount, That'll all happen behind the scenes. The deductions for children, most of that's going to be on the agreement tab. If the supporter, so if Dick were going back to school, you would put a start year for he's going to school year 1, year 3, an end year, and how much he's going to use for tuition. If he were claiming one of the children, you could put in one for eligible dependent. The other personal deductions would be things like the disability tax credit or something that is particular and one-off to this person, not some of the other areas which are already calculated. Then if we go to our recipient and put in that person's name, their age, where they live, what province they're in, and that sort of thing. Also, you can put the notes in here. In this case, if they're going back to school, starting now or starting 2 years from now, you would put in that this is how often, how many dollars they're going to be able to use as a credit. And in their case, because it's for their own and not a transfer of child tuition, they could benefit from more. Number of eligible dependents if there are any for them, and same thing here. So then if we go back to that agreement tab, these are the things that you might look at. The opening net worth is going to happen automatically, and we'll look at that later. But on the agreement tab, this is to do with spousal support and child support. And so if it's indefinite support, of course, you could just leave it go to 99, because 99 is going to go past your 25 years. You can type in any dollar figure as long as it's annual. And you're going to see it on your screen on the graph. And if we put in an index, it's going to increase it by the same amount as the person's salary increase. If there were adjustments, maybe in year 5, there's an increase because the first child leaves home. And then maybe 12 years down the road, it actually goes down because Dick retires and his income reduces, so it's going to go down. And all this you can see on the graph. So here you're seeing your 24,000 start, the increase being applied. Year 5, though, it jumps to an extra 5,000 because the child support's been reduced. We go down here, we see that the $4,000 reduction because Dick retires is applied. Here, the end of the child support would usually be when the last child is done. So if you put whatever year the last child's going to be done and put in a figure for the child support again, you're going to see that. If the indexing is applied, you see that. And when we see year 5, things change again. Then maybe you're going to see why there is a reduction or an increase, and it needs to have a negative if there's going to be a reduction. And so again, you would just hit save. So if we go back to Dick, then we have all of these other tabs. So income, expenses, savings, any debts Dick has, real estate, and investments. So everything up to there is all an input as far as their situation. And the rest of these are things that are showing you the graphs of the output. So if we go to income, and we'll just push this over, we have a number of options. So If Dick is getting a DC plan, he's got an employment, but it's connected to a DC plan, so defined contribution, you would use this to increase your fields and be able to enter that information. So you can put in the name of his employer, how much money is Dick earning right now, and if he's getting an increase in his income, then this contribution is his contribution to the pension plan and then the employer's contribution. So if you put in a percentage, that would be the percentage on his $250,000. If you knew the pension balance, you would put it in there, or if it were a locked-in account, you could put it in there. You would also enter the rate of return, when he plans to retire, and at what age does he plan to do the withdrawals. So maybe he's not going to withdraw right away, maybe he's going to go to 70, but he's not going to go to the normal RIP age. And then how much is the return once he retires? Is that different or whatever? So you'd put it for these things. And then again, you could save. Now you also have the opportunity down here if he has other sorts of income. So if he was self-employed, you could choose that and fill in when that started, if it's in the future. If Dick's been working and had self-employed income for the last 10 years, then you just leave the start years blank and only put in for an end year that he, let's say he's only going to do it for 5 more years, and he's getting $25,000 from there. You would put an indexing increase if that applied, or not if it didn't. Now your other options could be non-taxable income, could be that they're receiving monies that are not taxable. Maybe it's disability money, maybe it's some sort of money they're getting that's an honorarium, anything that would be non-taxable. If he had a defined benefit plan, you would enter the pension in here, and you also would have picked defined benefit instead. So if we choose defined benefit, then the fields that are there change. You still have the current pay, the increase on his wages, and how much he and the employer are contributing. Retirement age would be the same. So in that case, you would look at choosing pension though, and here in year 14, well, it would actually be year 13, you would see him getting his pension, and put in the annual figure and whatever indexing that would be. And what you can look at, here you see the self-employed, here you've got him putting money into the plan. And if we keep going, that just gives you his age and year. And here we're seeing the $30,000 start with his pension. And right now that's all we have. If we carry on down, you can change the year CPP is going to be received. Now in his case, we'll leave it. And if he's worked all this time at good wage, he'd have 100%. And so then it shows you how much that CPP is going to be. If it were that he's going early, well then it would be a reduced amount, or maybe this is somebody who worked out of the country, whatever. And then old age security, the maximum that you want. The times when you wouldn't have 100% maximum on old age security would be if the person was not a resident the whole time, and so they didn't qualify for full old age security. And now with more immigrants, that certainly is not abnormal. So then if we go to his expenses, you would enter in, and so whatever he's spending now, so if he tells you his basic expenses or lifestyle expenses, whatever you want to enter in there, are $30,000. Again, you see it pop up here, and there would be the cost of living that you would put in here. If he had things, so let's say we know that he's going to be paying from now right through for the next several years tuition. So it would show you that for the next 4 years, this is what he was going to be paying out to help with the tuition. If there was any way that was increasing, you'd enter it. If not, you wouldn't. If it's starting as of year 1, you're just going to leave it at blank. If it was starting in year 1, then it's sort of after year 1. So then you would see 0 in there, and it would actually be the beginning of the second year, and for 3 years it would show up. And then if we look at savings, this shows you how many assets that are liquid that they would have. And this normally would be bank accounts or that sort of thing. The interest rate is not going to be very high right now, but you would put in whatever they might be earning. Then what's their R.S.P balance? So you put in whatever they have as a balance in the R.S.P. Find out how much room they've got and enter that. If you don't know it, it's something you'll have to ask them for. What's the rate of return? You enter that. When do they plan to convert it to a R.F.P? And what is the return then? Our last section is the tax-free account. So you would enter how much was in their tax-free now. If they had room, what the rate of return is on their tax-free account. And then, of course, any notes if you so chose. The next tab is debts, and this allows you to take on new debts or if you've got existing debts. So if there was an existing debt, you could put in how much they were paying annually. So this shows you that they're doing $500 a month, but you don't want to put 500 because that's going to not be the annual amount. You put in the interest charge on that, and if you want it to be done, then maybe in year 2, that's the last of your payment. And if there was a new something coming up, so let's say in year 2, he's going to buy a trailer for camping, then that's what you would do, that you would enter it and it would show up in the future. Real estate, you're going to be able to put in what they do have each. Now, if it was joint, you can put 50% for each of them. If somebody owns something outright, then you're going to put in whatever the value of it is. If there is a mortgage, what's their monthly payment? And how much are they paying interest on right now? Now, if they were going to sell it, or let's say we'll put a second property in here. So let's say they have a chalet, and so they're going to sell it in year 2. You can see all this happening over here. This is the values. This is the mortgage. Here's the condo getting sold. And if there's a mortgage, you'd put that on. If not, then you leave this all blank. And what you look at is, okay, is there an annual increase for both of them? And there would be no tax on the marital home, but there would be tax on the capital gain. So you would also save that. And then if we go to the Investments tab, you've got a couple of options here. So you could put a description of what you're holding and the market value. And this would be a proposed earnings increase. And you've got a number of things that can happen. You could have it taxed annually so that it's taxed on its earnings every year, taxed on disposal, and so if we said in year 5 it was getting disposed of, and a $5,000 capital gains that hasn't been realized yet. So then if we look at that, there you are. Here's your value increasing. It's paid out. So there's your proceeds, and then there's the capital gains. So that for that year 5, we're going to see that when we look on other things. Now we've got all this information in here. We'll just go back and look at that complicated investments, because this shows you what that would do. So if we go back there and say, okay, well, Dick actually has complicated investments, and you want to use a manual entry, you would have to look at everything, because now you're going to do all the calculations yourself. But here you are, you've changed things. You've got an option to say that he's going to be fairly active. Let's say there's a capital gains of $2,000 in the first year. He's got $1,000 worth of eligible dividends, no regular, and the cash flow in this particular situation is going to be $2,000. So it's possible to do this and go through everything if you didn't think that this fit you the other way. So then if we go back to there, you're sort of all done all of your fields, and this would be clicked on if it was applicable or not if it wasn't. If we look at that base cash flow, now what you're going to see is an output graph. First of all, there's this colored graph, and we don't have anything in for Abby, so we can't see the difference between the two of them. But what we do see, if we look at everything, is this is that sale of the cash, so net cash flow. Here's his real estate purchase and the loan. Here's the income tax year by year. And if you want to, there's a couple things you can do. You can do separate taxes, and then it'll actually show you the CPP, the EI, federal and provincial taxes. The other thing you can do is print a one-year tax breakdown. And what that does for you is it shows you his situation on a calculation sheet. So it shows the employment, self-employment, his spousal support, and that sort of thing. So that's his total income. If he had made an R.F.P contribution, we would have identified that. Then this is the expected taxes. And there's his personal credit, both federally and provincially. We didn't give him any other credit. There is, if we had eligible education credits, it would show up here. We did click off eligible dependents, so that does show up for both federal and provincial. And then, of course, your employment, EI, CPP, and that sort of thing. And it does give us a bit of a summary at the end to show where things were at. And even though they were doing okay, we're seeing some negatives. So if we go back to Dick and look at the adjusted cash flow, you actually have a ton of things that you can do here. So if you look at your columns, there's his income, his taxes, that loan, the net cash that came in, and his real estate. Outgoing shows what's the outgoing amounts of money. And if we keep going, there's that 5 years of equalization. Everything before the asterisk shows you the basic cash flow. If we look at down here, though, That's at 65. So it's not very far away. And then here's the unallocated. You have the opportunity here with these negatives to make those change. So for example, you could have during these unallocated periods, you could say, okay, if you saved into your TFSA and maximized it, then there you go. You've got these extra contributions which took out of the unallocated. You could always say you're going to beef up the R.F.P. and see what that does. And so if you were to put more in, you could pick throughout his working year and do that, and it would show the maximization. Or you could pick a specific year. So let's say in the first year you're thinking, okay, well, no, I want him to do $10,000 instead. You can type right in that field. So in any of these, the R.S.P. contribution, the TFSA, the savings, let's say here we just said, okay, well, let's put all those savings into something. If we put savings contribution in there, it'll come off of the unallocated. And of course, you can do it, and you notice what happened is when we did those savings, it allowed more money to come out of these RSPs, and so this changed this. So that's one of the things that changed it. There are a number of things. If we went and said, okay, well, he doesn't want to do RSPs, so let's clear that. So it takes it off. So he still has this deficit now. But we can easily look after that. There's just as much as we did the contributions, we could do TFSA withdrawals. And so in that case, you're looking at changing your years. And then just change this to be however many years. And you could have it just cover the deficit if that was possible. So it does for a while, but that's not going to do the trick the whole time. You could also go and do the extra RIF, and we'll just increase our years there to be on the safe side. And there we go. So we were able to bring him back to 0. And if we look at his net worth, we've got a graph, but we've also got all the different things. How much was in the pension plan if he had a DC pension plan? How much was his RSP worth? This is when it then turns to a RIF based on what we said. Here's his tax-free growing. Here's his savings balance, his real estate, the mortgage balance, taking on new highs. So then if we go and we'll fill in some stuff for Abby, and then you can see what that does for her. So in her case, let's just move this over. So if she had a defined benefit plan, and her pay, and perhaps she's with the government and her wages have been frozen. So here's her contribution to the pension plan, her employer's contribution, and when she thinks she's going to retire. And again, other things that could be, there could be rental incomes. You could put in eligible and registered dividends. And again, as we said, you could have the non-taxable. So in this case, we do need to definitely put in a pension amount. And so we're seeing at 65. So really we're looking at it starting in year 18. And so we want her income to coincide with that. And you're entering in the pension amount. So again, for her, we need to look at, is she going, if we change this and instead said she was going to retire at 60, maybe then she wants to do, oh yes, of course that would change here. So 60 would be, and so in her case, perhaps she's going to have done okay with that, but she's only going to get 64% of her CPP. That's her pension starting out, but then there's her CPP, not too flashy. And again, as long as you're a Canadian citizen for the whole time, you're going to be able to put 100% in here. And if we put in her expenses, you're putting in how much it is annually, what the percentage is, and if she were the one going to school, you're going to enter that in. And there you see from year 1 to 3, no problem. And that's her portion. And again, you put in that percentage if was necessary. In her savings, could be it's just a basic bank account. You're entering in the R.F.P, the R.F.P room, how much she's going to earn, when she's going to start changing it to a RIF, and then what rate of return will the RIF get. We're seeing her tax-free savings, entering 0 in this particular case, and getting a rate of return. Now again, the debts, you would put in whatever was in her debt situation, the amount, the interest rate, and the payment. For her real estate, if she's got the other half of the house, perhaps, and again, if there was a mortgage, you could enter that in for her half. Payments, and if there's any annual increase as far as the building going up in value. And again, when you look at the real estate, it's showing you she's got this value plus this mortgage. Here are the payments for kids. Market value shows you the mortgage amount and that sort of thing. And investments, for our purposes, we'll say she has none. Now if you look at her cash flow, now we've got a graph, and because both of them are there, we can also say show both. So it gives us that graph to show us where things are at. And if we look at her thing, here's her income, and of course changing drastically in that year. You're seeing that, oh, I need to bump this up to the other year. Here's her CPP. Her OAS is down here because she's younger, and it won't change until 67. One of the other things that we can look at here is print the 1-year tax breakdown. So if we click on that, it gives us a summary of their tax situation. So it shows for Abby, this is her employment income. That's what she's getting. And we didn't have other monies here, but she was getting spousal support and rental income and a little bit of interest. So that gives you the total income and the taxable income. So then it shows the tax to be paid federally and provincially for the tax base. What's the personal credit amount or any other credit? So that's the education credit, the eligible dependent, the other eligible dependent, employment, EI, and CPP. Then again, what's the total effect? and again with the credit. And here you would also see then the adjusted tax and the final tax. So it's often good, especially to show what's going to happen with somebody receiving support or giving support to the other person, what benefit or problems are in their future. If you want to print, you can hit print, and that will bring up the print preview. If you clicked on the print preview button, this will print that one page. You can also go, and besides the selecting tab, you could go print all, and then it will just send all of it to the printer for you, for that individual. And if we go back to Abby again, and again we've got the adjusted cash flow, which allows you to do the work on there. And sure, you're seeing unallocated, she's fine up until down here. So same sort of thing. We could always have extra RIF withdrawals, and we would look at what year that was. So you enter that year and then to the end, and potentially cover the deficits, apply, and sometimes you wind up hitting apply till this ends, so it shows you those extra RIF withdrawals, which almost brings her to a good position. And then again, if you look at the net worth, now that they're both there, you can click on this and you get a graph for both. And this shows the R.F.P balance, the TFSA balance, your RIF balance, any savings. And if we go and hit print for this, page 1 is going to be your overview of the net worth, and page 2 is going to be the graph, which identifies who's where. If we go back to the agreement tab, we could click on opening net worth, and here we get a summary who has how many RSPs in the various names. They're tax-free. Here we're showing the supporter's property and the recipient's property, stocks, which is the vital, and then here's the mortgage amounts and that sort of thing. So basically that gives you an overview of all of the different fields and what the program can do. So I hope you found this helpful, and that we'll look at also entering in a future video a case study with you. Thank you.